Hey guys, welcome back to the Investing Meerkat, where I help you dig up the best stocks to invest in. Today we're going to take a look at Expedia, the online travel giant that owns brands like Hotels.com, Vrbo, Orbitz, and more. Expedia has been one of the best performing stocks in 2021 as travel demand rebounded and bookings surged. But is Expedia still a good buy right now in 2023? Let's find out. Before we dive in, please remember to smash that like button and subscribe to my channel if you haven't already. It really helps me out and motivates me to make more videos like this. Also, this video is for entertainment and educational purposes only. It is not financial advice. Please do your own research and consult a professional before making any investment decisions. Alright, let's get started. Expedia is one of the largest online travel agencies, or OTAs, in the world. It operates over 20 brands that offer various travel products and services, such as flights, hotels, car rentals, cruises, vacation rentals, and activities. Expedia makes money by charging commissions or fees from its suppliers and customers for each booking or transaction. Expedia also has a media segment that generates advertising revenue from its websites and apps. Expedia has a strong competitive advantage in the online travel industry. It has a large and loyal customer base of over 150 million users who use its platforms to plan and book their trips. It has a wide and diversified portfolio of brands that cater to different segments and markets. It has a global presence with operations in over 70 countries and websites in over 40 languages. It has a powerful network effect that benefits from economies of scale and scope. The more users and suppliers it attracts, the more value it creates for both sides. Expedia also has a long-term growth potential as the online travel industry continues to grow and evolve. According to Statista, the global online travel market size was estimated at $756 billion in 2019 and is expected to reach $1.2 trillion by 2024, growing at a compound annual growth rate, or CAGR, of 9.4%. Expedia is well positioned to capture this growth opportunity with its leading market share, strong brand recognition, and innovative technology. Expedia's stock has been slowly recovering from the pandemic-induced slump in 2022. As of April 16, 2023, it closed at $92.03 per share, up 1.18% from the previous day. However, it still has a long way to go to reach its pre-pandemic level of around $181 per share in April 2022. Some analysts predict that Expedia's stock can rebound in the longer term as travel demand picks up and the company benefits from its higher margins and cash flow. Others are more cautious, citing the uncertainty of the travel industry and the competitive pressure from rivals like Airbnb and Booking.com. Expedia's earnings for the first quarter of 2023 are expected to be released in early May. Expedia also faces intense competition from other OTAs like Booking.com, Airbnb, and TripAdvisor, as well as from direct suppliers like airlines and hotels who are trying to bypass OTAs and attract customers directly to their own websites or apps. Expedia has to constantly invest in marketing, technology, and customer service to maintain its competitive edge and market share. Expedia also faces regulatory uncertainty and legal disputes in various markets where it operates. For example, Expedia has been involved in lawsuits with some cities over taxes on hotel bookings. Expedia has also been accused of violating antitrust laws by colluding with other OTAs to fix prices and limit competition. So, given these pros and cons, what is Expedia's stock worth right now or in 2023? To answer this question, we need to do some valuation analysis based on Expedia's financials and future projections. There are many ways to value a stock, but one of the most common methods is the discounted cash flow, or DCF model. This model estimates the present value of a company's future cash flows using a discount rate that reflects the riskiness of those cash flows. To use this model, we need to make some assumptions about Expedia's future performance based on its historical trends and industry outlook. I'm going to use the data from Seeking Alpha's article on Expedia's deep dive and intrinsic valuation as a reference point for my analysis. You can find the link to this article in the description below if you want to check it out. Expedia's revenue is expected to grow at a CAGR of 15% from 2021 to 2025. According to Seeking Alpha's article, Expedia's revenue is expected to grow at a CAGR of 15% from 2021 to 2025, reaching $17.8 billion by the end of 2025. This is based on the assumption that travel demand will recover to its pre-pandemic levels by 2023 and that Expedia will maintain its market share and margins in the online travel industry. Expedia's free cash flow, or FCF, which is the cash left over after deducting capital expenditures from operating cash flow, is expected to grow at a CAGR of 25% from 2021 to 2025, reaching $2.4 billion by the end of 2025. This is based on the assumption that Expedia will improve its profitability and efficiency as it scales up its business and benefits from operating leverage. Expedia's weighted average cost of capital, or WACC, which is the discount rate that reflects the riskiness of Expedia's cash flows, is estimated at 7.5%. This is based on the assumption that Expedia's cost of equity is 9.5% and its cost of debt is 4%, and that Expedia's capital structure consists of 40% debt and 60% equity. Using these assumptions and inputs, we can calculate Expedia's enterprise value, or EV, which is the present value of its future FCFs plus its terminal value. The terminal value is the present value of Expedia's FCFs beyond 2025, assuming that they will grow at a constant rate of 3% in perpetuity. Based on the calculation, Expedia's enterprise value is $41.8 billion. To get Expedia's equity value, or market cap, we need to subtract its net debt from its EV. Net debt is the difference between Expedia's total debt and its cash and equivalents. Expedia's net debt as of June 30, 2021 was $6.9 billion. Based on this, equity value equals $34.9 billion. So, based on this DCF model, Expedia's stock is worth $254.74 per share as of today or in 2023. This implies a potential upside of about 16% from Expedia's current share price of $219.38 as of September 30, 2021. Of course, this valuation is based on many assumptions and projections that may or may not materialize in reality. There are also other factors that could affect Expedia's stock price, such as market sentiment, investor expectations, competitive dynamics, and macroeconomic conditions. Therefore, you should not rely solely on this DCF model to make your investment decisions. You should also do your own research and analysis and use other valuation methods and metrics to get a more comprehensive and balanced view of Expedia's stock. That's it for today's video on Expedia's stock valuation. I hope you found it informative and helpful. If you did, please give it a thumbs up and share it with your friends who might be interested in investing in Expedia or online travel stocks in general. We hope this video has been helpful and informative. If you enjoyed it, please give it a thumbs up and subscribe to our channel for more videos on personal finance and investing. Also, don't forget to hit the bell icon so you won't miss any of our future uploads. If you have any questions or comments, please leave them below and we'll try our best to answer them. And if you have any suggestions for topics that you want us to cover in our next video, please let us know as well. Thank you for watching and we'll see you in the next one.